Hey everyone, this is Mark with a special archive episode of With Flying Colors. I hope you enjoy. I'm here today with Todd Miller, formerly of NCUA, and of my team of experts that help credit unions. Todd, how you doing today?
I'm doing well.
I'm having a good day as well. Today, we're going to talk about a topic that we've hit with a lot of our conversations with credit unions. We've hit at different times in different podcasts, but it relates to the board package and what should be in a board monthly package so that the board sees what they need to see. And oh, by the way, how will that package rise to the level of making NCUA comfortable with what's in that package? So you can call it the optimal board package. You can call it a good board package, the perfect board package. That's what we're going to chat about. But before we do that, just in case someone's listening to this for the first time, if you could give a little bit of your background at NCUA before you started working as a consultant to help credit unions. What's your history at NCUA?
Certainly. So, Mark, I spent 34 years with NCUA. You can break it up into about three parts. The first third or so of my career, I was an examiner and a problem case officers. That middle third, I was a regional capital market specialist, worked with good credit unions and bad credit unions and everything in between. Actually, during that time, helped a lot of development of policies of how NCUA looks at interest rate risk and looks at liquidity risk. Did a lot of examiner training. Then the last third of my career, I was the director of special actions in the Western region, supervising problem case officers, capital market specialists, the regional lending specialists. Between that capital market specialist year and the director of special actions, you created a lost year for me where I spent a year at Westcor. And then I started my director of special actions role right in the middle of a recession. So it made for some pretty interesting times. And I
Dates
enjoyed my career with NCUA. It was a blast. I enjoyed all of it. The board package that we're going to talk about today, I conserved a lot of credit unions. I returned a couple to the members. So how board reports fit into this is near and dear to my heart.
Yeah, and for the listeners, conservatorship is when NCUA removes the board and serves as the board and the insurer and the regulator. And when that happens, the staff at NCUA are basically running the credit union. They'll have a CEO. They get very hands in that regard. And so that's what Todd's referring to there. And by the way, there is a podcast on conservatorships that I can put a link into the show notes. So if you're curious about conservatorships, there's a whole podcast on that topic. All right, let's board policy, a board package. Let's start walking through what should be in a good board package.
Well, I'm going to just give a little background and just throw out, we've done other podcasts here on corporate governance. We've done them on risk appetite statements. And in those, we discuss the nature of this becomes a culture and part of the credit union's culture. And the board package is reflective of that. It's a foundation for establishing that board culture, but it reflects that board culture in corporate governance as well. At the end of the day, the board of directors, they're responsible for that general direction and control of the credit union. They set that strategic plan. They set those risk appetites. They're responsible for ensuring the credit union complies with laws and regulations. And the board package, at the end of the day, and at its very simplest nature, it's there to provide and help the board of directors make good decisions with respect to their responsibilities. We spent a lot of time in troubled credit unions. I think there's some things that come out of troubled credit unions. And one of the things is they always have boards that are actually want to act in the best interest of their members. And then how do they get in trouble? Usually it's because the board is misinformed about the credit union's risk position. They don't know what's going on. In rare cases, their management staff have misrepresented the whole risk of the credit union to them. But a lot of times they're just kept in the dark. And that was something that came up over and over in my career when you get into a troubled credit. Boards were in the dark as to where their credit unions were in terms of actual risk. So I think that's somewhat of an interesting thing. As I was preparing for this, I thought, I could Google what's in a good board report. I'm sure there's hundreds of web pages that will tell you, here's 8 principles or here's 10 principles or whatever, right? chose not to do that. I just made an own outline off of my own history here. Our listeners, they can go back and Google that and we'll see how much we hit and how much we miss. But I'm going to try and keep it a little bit more simpler and a little bit more direct.
Got it. So you talked about the misinformed on risk, and as you're talking through that, I'm picturing different conversations where you've been involved with some client conversations where there's like and I'm also thinking about the concept of form and substance, right? That you can have amazing data, but if it isn't handled in a proper way so that the board can easily find it and they have to spend the package grows and grows and it's just a data dump that's not organized well, that can create a situation where they don't understand the risk, even though maybe you can hunt and peck and find all that. But if it's put together and has that form, whether it's an executive summary on the top, I know you've had some conversations relative to some large credit unions where you've seen some really good board packages and some covers to that. So when I bring that up, what should be on the front end of a good board package in your mind?
You bring up a lot of things there, Mark, and
I did, yeah. So
really,
run with any of
have answers to all of those on this little piece of paper that's in front of me.
them. Let her rip.
So a good board package. So first off, NCUA, they don't have a lot of guidance, but they do say something about board reports in their exam guide. This is the only quote I'm going to read from anything today. The rest of it is all just going to be me talking, you talking. But NCUA, they put it in writing. They say reports to directors should support the complete, understandable, and accurate information appropriate to the size and complexity of the credit union. Size and complexity of the credit union is an interesting statement. The regulators use it all the time. And because of that caveat, there is no perfect board package. Credit unions are going to have a governance culture, a risk management culture, and their board packages are going to reflect that. All I will say between board packages, and it doesn't matter to the size of your credit union, you're going to have quantitative and qualitative information in there. Board packages, they do have a tendency to grow over time. You're always fighting this balance of what does the board want and what does the board need to have? And those are difficult questions to answer. Every board brings with it its unique skill sets and unique backgrounds. So how you present information to them is going to vary across organizations. How you order your board package and the information in it, it varies across organizations. You see some organizations, they put all this compliance stuff in front, and other places they put it in back. Some people start with a financial statement. Other people end with a financial statement. At the end of the day, there's no one right answer to how you organize your board package. We'll talk about some of the qualitative and quantitative stuff. The short version of it, and the way I always assessed it is, and this is Todd Miller's personal view of what a board package looks like. To me, board reports should reflect management's responsibility to demonstrate compliance with the business plan, board policy, risk appetite standards of the credit union.
Say that one more time.
So they should reflect management's responsibility to demonstrate to their board compliance with business plan, board policy, and risk appetite standards. And those are all things the boards put in place. They create that business plan, business strategy. They set all the policies. Board is responsible for setting that risk appetite. To me, board reports should demonstrate management's compliance with those items.
As you say that, I think of a couple conversations we've had with credit unions over time where a credit union's strategic plan said A, B, and C, and then what they did was B, Q, and R, and there was no pivot in those board documents. And so NCUA criticized and those credit unions pretty harshly because management really didn't do that, and the board didn't ask to see that in those situations.
It's fine if a credit union does that, but somewhere there in your qualitative board reporting and discussions, there has to be, okay, today's business plan ABC is not working. Here's why. And here's an opportunity to pivot and accomplish board goals by doing X, Y, Z. And here's the opportunity and risks entailed with that. Like I said, there's no right way to do it, but that's one of the things that comes out when your qualitative reports, and we'll talk about qualitative reports. They need to be clear, concise, provide context, but at the big level, your CEO, CFO, lending people, whatever the case may be, they should be providing explanations for deviations from plans. Why are we not able to do what we thought we were going to do? But we're in an election year. Things are going to change. We just went through a cycle where we went through COVID and we had these massive increases in interest rates, which no one can predict. You respond to those by laying out in your board reports and your CEO. Let's go discuss. The world has changed. Our risks and opportunities are different. We have to pivot. Here's how we're going to do it, and make that a discussion at the board level. So you lay that kind of stuff out in your qualitative reports. Um, Getting ahead of myself because you ask questions that get us to
Yes.
the end.
Just
And
get back to your agenda. We've got qualitative, we've got quantitative. Is the next thing that we do is walk through one of those or what? Wow.
sure, let's go through the quantitative reports first, because these are numbers. I will just say this, you break quantitative reports down into, I break them down into a number of categories. And I think you'll find in the literature, this is probably the same, even though I didn't look it up. You have key performance indicators. How are we doing financially? And how are we doing against our budgets and our strategic plans? You have key risk indicators. NCUA throws out a whole historical key ratios and historical ratios on their financial performance report. A lot of those are key risk indicators, key performance indicators. You have financial reports, and then you have budget and strategic plan updates. I think there's a couple things that in a good performing credit union you're going to see is there's going to be a lot of consistency in these quantitative reports. They're going to tell you where you've been, where you're at, and give you some indication of where you think you're going. And I think that's important with boards, especially because they're not there in the credit union every day. They need some measures to show where they've been, where they're at, where you're going. I think those pieces are in there. Now, the quantitative reports, this is very interesting. I like dashboard type level reports. And the challenge for any credit union is how do you summarize these things without providing too much detail? You give a board too much detail and it causes a couple problems. One thing, you lose your directors because they can't interpret the information. And the other thing, if you give them too much detail, it really invites boards to start micromanaging little numbers, and that's not their role. So board level reports, they need to be summary type of data. I like the dashboard things. I think it's important in a credit union that your board reporting, these numbers are reported in a consistent format, regardless of where they come from. If your CFO is giving you financial reports and he highlights variances with red, yellow, green, you should expect to see the same thing from the lending. You shouldn't see lending reports that use blue, magenta, and purple. There needs to be some consistency throughout the organization because it's how you build credibility, trust, and it makes it easier for your board members to understand data given to them. It used to drive me nuts when I would go into a credit union and say, okay, here's the financial trends here. And they go the oldest information on the left, newest information on the right. But then you pick up another report on the next page and it goes the other way. It's just like that just adds confusion to things. Let's keep this whole process consistent. And there should actually be some conscious thought put into that within an organization of how we're going to organize data. Now, along with a qualitative report like that, like I said, I like dashboards. Sometimes credit unions do need detailed information, but at the end of the day, there should be qualitative reports that go with these dashboards. Someone should be telling the board, hey, everything's fine. Let's go on the way we expect. Wait, we have variances here. This is not going the way we expect. Here's why. Here's what we're going to do about it. Sometimes you just need to explain to the board, here's the 2 or 3 key pieces of information on this dashboard. This is what you need to be looking at. Have any questions? And I also think one of the things I talked about where we've been, where are we, where do we want to be? I do think it's also important that credit unions have dashboards that compare themselves to their peers too. Where are our peers at? Where are our competitors at? Almost everyone does that in terms of setting loan and share rates, but you should benchmark your key performance and risk indicators against your peers occasionally too. It helps the board set that strategic direction. But I think the consistent formatting is available. If a board member wants to dig into raw data, fine, make it available to them. But I don't think it has to be in the reports every month. And I do think it's important too that boards, and especially on these qualitative reports from executives, they tell board members what's important, what's not in here. I'll give a couple examples that happened in real life about this. Most board reports, they don't have cost accounting system, cost information. That's a daily thing. It doesn't need to be in there. But I was in a trouble creating with them. They had 52 branches. 39 of them were losing money. I think maybe you should tell your board that's maybe something they need to know. And then contrast that with a credit union at the same time that's 2 states away within their strategic plan. They laid out, okay, we have multiple branches. We have small, medium, large ones. We expect them to make profitability within 18 months. And when the open them 20 on the small and medium ones, 24 months on the big one. They have a policy. If we have a branch that's losing money over a 12-month period, we're going to have a plan to fix it within 12 months, or we're going to close that branch. Or doesn't have to deal with it. Expectations are laid out. Here's what we're going to do. It's
You
kind
know,
of different.
those two examples you gave, I'm putting my old NCUA hat on, and you could see in your first example, all those branches losing money and not having the data. You could see a pretty rough exam wrapped around that, and maybe where examiners will point that out. And the other one, you can see where that it not only helps the board understand it, it helps the relationship with NCUA and helps NCUA get in there and get out quick because they can, they, you, the management team and the board has put together a package that is succinct yet provides the right information. And then the other thing when I'm thinking about dashboard, it reminded me of a Confucius quote, which is, it's a simple task to make something complex, and it's a complex task to make something simple, right? How do you, the work behind building that dashboard can be very complex, can be very challenging, but it provides a simple summary that someone can take and make decisions on and meet their regulatory needs, meet their needs of understanding the credit union because it was artfully put together to tell the appropriate narrative of what the board needs to understand.
Yeah. And you mentioned complex made simple. And probably the biggest area with respect to that is credit risk reports. You have a very complex thing, and this is the biggest risk in any credit union out there. Means if they fail, it was to be credit risk or liquidity risk, and if they have liquidity risk, that causes the failure. It's almost always because of poor asset quality at the bottom side. So it all comes down to this credit risk is the most significant risk in any credit union, and credit unions are involved in all kinds of different types of lending. You have your consumer lending, you might even indirect lending, you might have participation loans, you have various types of residential real estate lending, you have all these different types of commercial lending, and they all require different types of reporting structures. And how do you lay down what's important for a board, and how do you get them in a succinct 1 or 2 pages in each of those areas to understand what credit risk is? It's a very challenging issue. A lot of credit unions, they use a company called Encino to monitor their consumer loans. But you can break that thing down to where there's hundreds of pages, but there's also ways to break it down very easy in 2 or 3 pages to here's where our credit risk scores have migrated. Here's where our LTVs have migrated. Here's what this looks like when we combine LTVs with credit risk scores and how that changes over time. It can be done in 2 or 3 pages, but there's a lot of hours of work behind it to get it there. So the board doesn't get bogged down, but they still have a clear picture of what's going on with that portfolio. You'll see this with clients, all people that have business loan portfolios. You're making large loans quite often, 2 or 3 large loans, you lose them in a year, and it's a year's of profitability out the door right there. You will always see the examiners and the regulations harping on what type of business loan reports have to end up in the board package. And sometimes you think it's onerous. Board members sometimes might think it's onerous. But they're important pieces that the board has to look at and understand. You get another piece of this nowadays where credit unions, almost all of them have fairly complex committee structures that manage different areas of the operation. You have IT steering committees, you have ELCO committees, you might have a risk committee, you might have a business loan committee, you might have a regular loan committee. How much of that information makes its way to the board? Do you do that in summary or detailed information? It becomes a challenge. You do have to figure out a way to get all these committee type reports information to the board. And you don't have to spend a lot of time on them if things are going according to plan. The board should really try and keep their eyes focused on strategic direction. That's opportunities and threats. If things are going well, they don't need to spend time on that. They need to spend time on where do we need to go and how do we get there. And so it becomes a big challenge. But at the end of the day, all those committee stuff, it needs to be available to them. Today, that's easier than ever. There's lots of software platforms out there. A lot of people create their own software platforms where board members can sign in and look at it. I remember the old days before there was that way. I had one of the largest credit unions in the US in my district. I think they were the only credit that used every line on the call report. Well, other board packets came in a binder to me each month, one of these cardboard bifolds. I don't know, it was probably 250 pages, but they had 5 or 6 QSOs and all kinds of joint ventures. And it was very interesting. And I sat down with this chief operating officer of that credit union, one of the exams. There's all this stuff, get in here. So 50% of his examiners told us to put it there. We don't look at it. But you find things that, okay, this was a regulation requirement 10 years ago and it got thrown in the board packet and it never got taken out. The other thing that credit unions need to do, and board members and CEOs need to do this probably once a year or every other year, they really need to go back and assess their own packages. What are we looking at? Do we really need to see this? Is this important? Does it have to be in there? A lot of those things you do put in there, or if you've got subsidiaries and stuff, you might only talk about it once a year. And a lot of it goes through a consent agenda. I have found in that one credit union I was just talking about, do board members ever even look at this stuff or understand what's going on? And I was there for an exam one time and they just had a regular board meeting and the CEO invited me, just come to our regular board meeting. So, okay. That board meeting was very interesting. Those board members did read all that stuff. They did have questions on it. They did understand all of it. I was very impressed. So let's go back to kind of qualitative reports like that. You need to have executives need to summarize and address in a qualitative written format all these qualitative reports. And then they need to layer on top of that, hey, what's going on in the world that's increasing our risk? What's opportunities that, hey, we didn't think about them when we did our strategic plan 2 years ago, but here's something that we can do now that benefits our members. It will be profitable. Do we want to go down this path? Here's risk and rewards of this type of thing. So it's really important that, especially those qualitative reports, they address those risk reward things. It's important that they address deviations from plans. We have a risk appetite. We have a business plan here. We have a strategic plan. If things aren't going according to plan, those are the things the CEO, the CFO, your lending executives, they need to address those issues in their qualitative reports. Where are we having deviations from expectations? And the sooner you bring those things up, the easier it is for everyone to address them and pivot if necessary.
Can you think of the example of bad use of qualitative where you had all these branches that weren't making money, and then this other one where they were tracking it really well? Can you think of any anecdotal qualitative things that you've seen that were done either particularly well or particularly poorly? Nothing might come to mind, but any examples like that come to mind when I throw that out there?
The poorly done ones, there's lots of examples of those, especially with lending areas where you throw raw data at the credit union, or especially business portfolios where we don't really disclose a risk migration, or we'll even lay it out. Here's our business portfolio. Here's the totals, risk ratings, call it 1 through 8, bad, good to bad. We have some are at 7 or 8 here that are potential losses. But what you don't say within that is, wait, two of these are the largest loans in the credit union. They're not just an average loan balance. These are ones that can hurt us materially. And you don't share that information with the board. Material risk like that, you need to just throw it out for them. And the well-run credit unions, those qualitative reports, they're going to be looking forward towards opportunities all the time. We have this new emerging AI issue. What does that mean for us? We've seen credit unions that, when this is both good or bad, they play within the Bitcoin and the cryptocurrencies, and how do we provide services and safekeeping for our members? And we've seen examples of credit unions that have structured this extremely well, and others that have dived into it without really thinking through all the implications, and they've been heavily criticized by their examiners for doing so. 4 or 5 years ago, before I retired, you'd see a lot of that with the whole marijuana banking issue. That you got credit unions that dove into it. They did a lot of homework. They did an extremely good job with it. Other credit unions dove into it without doing their homework. And then you get an exam report and the board doesn't even realize, oh, wait, we had 300 marijuana banking clients here, and we've got a fine from FinCEN because we didn't handle our SARs appropriately. And I've seen examples of that in real life too. The boards just get surprised. Hey, we get a fine from FinCEN for not doing something, and we didn't even know we were involved in that line of business.
That's what they call a red flag. Definitely.
Yeah. More of the
Sure.
examples of the way where we've not really summarized for our directors those significant risks. We've buried them away in details. And that's where the qualitative reports need to come out, is let's not bury things in details. Another example of that, one time, in a member complained about their CD not renewing at the right rate, and they appealed it to a branch manager. Branch manager said no. They appealed it to the board. Management told the board, hey, we did the right thing. Board upheld their branch manager's decision how to renew the certificate. That member pulled out $4 million, and I had to go borrow that entire amount from the corporate. No one told the board that this member is appealing a thing here over $200, but no one bothered to tell the board that member had $4 million in their
Right.
$200 million credit union. Yeah, it's like maybe the board would have made a little different decision if they had the whole story here behind this appeal that came to them.
Yeah, that's a great example. I had a similar example. I read it in a USA Today back when USA Today was printed. It's a guy came in and was disheveled into the bank and wanted to get parking validated, and they wouldn't do it, and brought it all the way up to the vice president. But no one had the idea to look at. And he even said, "I'm going to close my account." And they go, "Sure, okay, let me go do that." And that's when the lights went on. They saw that it was the biggest depositor in that particular bank. So great point. Great point. Beyond qualitative, what else do you have on your sheet of topics? Todd's topics on board packages.
Like I said, there's no correct answer to this. I do think it's important that you keep your reporting consistent. Let's figure out what works. Let's keep this consistent. Let's not be changing it all the time. I think board calendars and board agendas are important. Different boards will look at how you go through this agenda in different directions. I've seen places where agenda one is our compliance report. That's the first thing we're going to look at. Are we in with all our risk appetites? Other places that's third or fourth down the agenda, and their first agenda item is, here's our financial performance this month, and here's the CEO's report, and here's the CFO's report. And somewhere in there, they eventually get to these compliance reports. But the important thing is you create a consistent way to whole approach your board meetings and your board packages. That builds trust with your board. There's an art involved in this because, like I said, you have to balance what the board needs to know with what they want to know. And based on their backgrounds, they want to know more. And there's always this fine line between giving them appropriate data versus giving them too much. And like I said, you have to be very careful about overwhelming your board with detailed data that they don't need, because it just creates a situation where they don't understand what your risk profile is, or it invites them to dig into micromanaging stuff that They don't need to micromanage. And that can create a world of problems in and of itself if the board starts micromanaging daily operations.
Great point. Great point. This has been, as always, enjoyable talking through some war stories, and think this is another great episode that credit unions can listen to improve their corporate governance, improve their relationship with NCUA. Any questions I should have asked you that I didn't ask on this topic, Todd?
No, but maybe I can summarize things in just a couple short points. Like I said, there's a lot of art and a lot of detail that goes into this, but at the end of the day, you're trying to accomplish a couple things with good board reporting. You want to present data that helps board members make good decisions. There's a lot that goes into that, but at the end of the day, that's what you're trying to accomplish is present data that helps board members make good decisions. And you want to give them a clear understanding of your current situation, and you want to keep their focus on future actions. Where do we need to go going forward? And that's a challenge. And sometimes I wonder, how did you accomplish that as the executive director or when you had changes at the NCUA board level? I have a feeling there was changes made each time you got new directors and new directions there, but maybe not. Maybe you guys were very consistent about things.
We were able to keep some things on track, but as I said, every time the board chair changed, it was purple became yellow and yellow became purple. A board comes in, like you said, what does a board want to know and what does a board need to know? They come in, every person is the journey that they've taken through time and what they've seen, what they've been exposed to, what they've seen elsewhere, what their particular interest in is that plays a role on it, whether it's the NCUA board or a teachers credit union board, which is going to have a certain, if they're all teachers, they were trained in one way. If they're all farmers, they're trained in a different way. I remember one of my favorite learning experiences when I was a new examiner was a credit union in a farming area, and the credit committee was all farmers and the board was all farmers. And I learned more about farming in that 1 week than I ever have in any point in time in my life. And I got a comfort level, but they were asking for particular things just because of the journey that they've taken. But Todd, that was a great summary. I think that's going to be the sound bite from this one is what you just summarized there. As always, I appreciate your thoughts on these important credit union topics.
Thank
Thanks
you,
for your
Mark.
time. Yep. Thanks for your time, Todd. And listeners, I want to thank you. As always, thank you for listening. I hope you'll listen again soon. Mark Treichel signing off with flying colors.